I'm going to start with an overview of what's going on, but in a way, I want to begin by just first of all thanking the university, thanking Jessica Rotter, the communications manager, for helping put this together at the last minute, thanking the Law and Political Economy Society at Willamette for co-hosting this event and for all of their broader programming, keeping important systemic questions of political economy relevant to the law school and the intellectual discourse that we're trying to build on campus. Given that this is only an hour event, this is a very complicated issue. I wanted to first of all introduce you to some other thinkers who I think are kind of at the forefront of the current discussion around this. You know, this is one of these weeks where decades happen, and it's one of those areas where it's very important to get a sense of what's going on for people who've been thinking about this in advance. You know, I think of a lot of these moments sort of like surfing. You're out there paddling on a board, trying to make sure you're not, going to drown, all that kind of stuff, and waiting for the wave. And when the wave comes, the job is to sort of pick it up and run. So these are some of the names that I would suggest you check out. Nathan Tankus from my organization, the Modern Money Network, former OCC nominee, my former doctoral advisor, Sally Omarova, my colleagues Morgan Ricks and Lev Menand, who've written about a number of these issues, Kate Judge at Columbia, and Peter Conti Brown at Wharton. We don't agree on everything, but I think we all care about the same kinds of issues. We see enough of this stuff in the same way that we can have an important conversation about where to go next. And I encourage those who are interested in this area, if you want to start sort of seeing where the cutting edge of this conversation is, you would do worse than to follow these people and read up about their proposals and ideas about both the history of banking and the various dynamics that got us here, and pathways out of this kind of system. I'd also recommend for those interested to kind of follow some of the more cutting edge journalism. People like to say that journalists provide the first draft of history, but there's so much noise out there, it's often hard to know where to start. My colleague Nathan writes what I think is one of the most informative crises-oriented newsletters out there called Notes on the Crises. It's a subscription newsletter, but you can also access a lot of the posts for free. And I think in this period, all of his major posts are going to be free. Bloomberg's Odd Lots podcast is one of the kind of go-to easy to understand podcasts around finance, and they're always kind of up to date on current affairs. They've already had some of the speakers I mentioned on the last slide already in the last couple of days. I highly recommend putting that in your roster if you're the kind of person that can stomach finance. Financial Times Alphaville is a blog that is also kind of does a great job of the really cutting edge finance issues, and particularly I think Alexandra Skaggs and Brendan Greeley have written some really great pieces there in the last couple of days. But you would do worse than putting that on your reading Rolodex as well. And then lastly, probably the most indispensable newsletter out there in the finance world, shouldn't come as a shock for anybody that follows this stuff, is Matt Levine. His money stuff is not only very brief and terse and to the point and packed full of nutritional vitamins and content, but is also usually pretty damn funny, which in this very dry technical field is what keeps us all sane. If you really want to be bold, if you really want to kind of take the training wheels off, you could go onto Twitter, where a lot of these debates take place in live time. Finance Twitter, or FinTwit as it's called, no less of a hellhole than the rest of Twitter, but also probably the place to get the raw, unfiltered, octane version of these discussions. You'll see the speed at which intellectual debate moves in this day and age, separate from the kind of slow-moving, once every 6 months sort of cycle of journals and things, which in this particular area is actually almost more of a net negative than a positive. There are a lot of issues around banking history and kind of large-scale issues that can be addressed in the with the sort of luxury of time and space. But when you're trying to make decisions kind of in crises moments in live time, you don't have the ability to wait for 6 months of editing to have a new idea get out there and then be discussed. By the time you go back and forth 3 or 4 times between people, half of the decade is over, and most important issues have become obsolete. So Twitter is the place to actually kind of get stuff in a cutting edge sense. I would strongly recommend, if you do that, to sort of curate your reading list first and foremost around the financial journalists, who are themselves curators of the broader discussion, and then go from there. If you have a Twitter group of financial journalists and legal finance experts, what will emerge in the negative space between those different nodes in the network will give you a pretty good mosaic picture of what's going on. So this is an interesting period. That old Gramsci quote that the old world is dying and the new world is struggling to be born. I think what we are seeing in this moment and what this crisis represents in many respects is a kind of perfect storm, because unlike many major crises, it's not taking place against the backdrop of a larger economic collapse. We're not seeing homeowners, we're not seeing companies like General Motors, we're not seeing entire industries struggling. This is a very localized problem in a very localized industry and a very kind of narrow surgical problem in the banking system structure that has resulted in a narrow surgical response. And as a result of that, the political and ideological implications are much more apparent and at the surface of this issue. What you've seen in the past with these kinds of crises is there's so many different moving pieces. It's so complex to get a sense of what's going on that by the time the dust starts to settle, people are kind of going in all sorts of different directions, and the general public has kind of gotten tired or bored and moved on. But what we are seeing now is a kind of short, sharp break of something that has relatively high significance to the future of the system, but also relatively low salience to everything else. So this is an interesting moment where, unlike a lot of other crises, we are not getting bogged down and distracted by 7 other problems. We can focus on it acutely, and the speed at which the change happened has meant that the narratives have essentially congealed quite quickly. You know, I would expect in other crises it'll take a couple of months for the consensus position to start to emerge, but I would say we're seeing a pretty fast consensus about what happened here and what is implied by it, and that's stretching from the journalists and the experts through to the administration and the elected officials in Congress, who are already starting to make calls for quite large changes to the banking system in ways that the rest of the world is almost suffering whiplash, saying, wait a second, we just spent 10 years building a different system, and now you're saying we have to go in a completely different direction. And to sort of re-emphasize, this is a period where the ideological character, right, the politics of this are perhaps more important even than the economics. So a lot of these problems that are underlying this particular crisis are not ones that are super convoluted. We're not talking about exotic derivative products. We're not talking about 7 layers of shadow, financial institutions that we have to sort of get a very huge map on the wall to even sort of understand. We're talking about things that we thought were the case that turned out not to be the case. Fictions that we thought we could perpetuate that are revealed to be far less stable, far less long-term, far less healthy than we thought. And so one of the questions is, how can we make sure this crisis moment doesn't go to waste? How can we make sure that once things sort of revert, or once we deal with the acute bleeding in this moment, we don't simply immediately start forgetting and go back to business as usual? How can we skate to where the puck is going, look around the corner of what the implications of this crisis are for the better financial system that we should have had beforehand, but we can certainly put more pressure to build now. And as I have started making a habit of saying in almost every one of these talks now, a quote from my father that he had when he was in the federal bureaucracy in Australia: there's never time to do it right, but there's always time to do it again. A lot of these problems are not, in fact, new problems. That's the problem, that they are very old problems. They are ones that we have avoided dealing with over and over and over. And once again, they have reared their head in a way that hopefully will be the last time. Like, the thing that we can do, I think, in these moments, more than anything else, is honor how serious they are by trying to ensure that it's the last time they ever happen. So I've tried to think of different ways to set up this conversation. I did a 2-hour Twitter Spaces with my colleague Nathan the other day. I just recorded a podcast this morning and recorded another one yesterday, and I've had a few chances to have different starting points in this conversation. But given that I invited myself here, and again, thank you for everyone who chose to attend, and given that I didn't have the time to bring in anybody else who could potentially set us off on a different starting point, I figured I might as well be somewhat self-aggrandizing and put my cards on the table, which is that I wrote a short piece. When I say short, it was about 15 pages, and in the grand scheme of law reviews, where you're contributions are measured by the pound of paper that you waste. It's not considered very substantial, but it said what needed to be said, in my opinion. I wrote this piece back in 2015, and it was published 2014, 2015. It was published in 2017. I think this crisis really is vindicating a lot that I had in that I wasn't expecting to be kind of vindicated in any immediate period of my lifetime. But the context of that paper, which you can access at the link below, was actually a very different issue. It was the debate around creating a government digital currency, which even back then wasn't actually much of the focus of the debate. It was still around crypto at the time. It took Facebook's Libra in 2019 for public policymakers to really wake up. But the debate at that time was very concerned with the idea that if we created a government digital currency, something that Federal Reserve and the European Central Bank and others are very seriously looking at now, and the government of China is already there, a number of other smaller countries are already there. The concern was, what happens not if it fails, but if it works too well? What happens if we create a way for everybody to have an account at a government entity, whether it's the post office or more likely the central bank, and it is safe, so you don't have any risk of losing your funds there. It pays a decent interest rate, and you can make transfers immediately, anywhere you want, to anybody you want, with no cost. And it's nice timing that I mentioned this, given that the Federal Reserve announced just today that it was ready to launch its Fed Now service in July, which is an attempt to move towards a real-time payment system along the lines that I just said. Although we don't have universal access to it, it's still restricted to banks and other financial institutions, maybe. But what happens if it works too well? What happens if everybody said, that's it, I'm done with Chase, I'm done with my credit union, I'm moving my funds to the government, I don't have to worry about any crisis ever again in terms of banking and all that kind of thing. I don't need complicated products. I just want a simple, dumb place to put my cash, to put my digital money, and then I don't have to think about it. And they were actually very concerned about that, somewhat ironically. They were concerned that the technology might work too well, and in doing so, the banks would lose access to depositors. They would lose access to the funds that depositors bring. You'd put a $100 bill at the bank, right? The bank gets to own that $100 bill. It gives you a bank deposit, which in legal terms, with my contract law hat on, is a liability, a contractual debt of the bank to make payments on your behalf, to give you money on demand. And just to be clear on this, and this is something that I try to hammer through my classes that I teach, they don't need your money to lend it out. The bank doesn't take in your $100 bill and then give that $100 bill to another customer. When you come in and make a loan, the bank itself issues money. It issues deposits that we treat as money. When you look at the money in your bank account, there's not sort of coins in a vault like in a Harry Potter story. There's no $100 bills in a vault like in an Ocean's 11 movie backing up all of those. They are simply IOUs of the bank that, through various regulatory and legal arrangements, we treat one-to-one with government money. So my view on this was we should make this explicit, and banks should be able to do this without any limit, with the recognition that turns them quite explicitly into public-private partners. But the way that banks work today is we give the impression that they are simply issuing their own IOUs, not something that is explicitly public, unless it is guaranteed by the Federal Deposit Insurance Corporation, which I'll get to in a second. And the concern was that if banks lose all of that funding, it will be more expensive for them to be able to make loans. When you take your money out of a bank, they need to find the cash. That IOU has to be converted into real dollars. And when you have a bunch of individual mom and pop depositors, that's a cheap place to get money. They don't ask for as much interest as institutional lenders. There's less stigma than borrowing it directly from the government or from other banks. So even though banks don't need your money to lend to other people, they like having your money because it's a cheap source of funds when they need it. And also they get to charge you fees and fines. And if you look at the sources of bank profits nowadays, yes, they still make money on making loans. They're still fundamentally credit issuers, but they also make money basically on transaction fees, on fines and all that kind of stuff. So the two major visions that banks do today, right? One is they issue that deposit that we all treat as digital money. And two, when they make loans, they do something that the government doesn't really want to do. Maybe the government should do that. And we're having a whole conference at the end of the week next week around the possibilities of creating a public bank in Oregon. But the thing that we have currently delegated to private commercial banks as part of this public-private sort of partnership arrangement is the responsibility to conduct credit analysis and underwrite individual loans, to look at an individual borrower who comes in the door and says, hi, I'd like to get a loan, and to decide whether you should get it, whether you're a good credit risk, whether you're likely to repay, whether the interest rate that you're able to pay offsets the risk that you're going to default, and to take some responsibility if that turns out to be false, to bear some of the cost, not necessarily all of it, as we'll talk about, but some of it if you turn out to be incorrect. This might be a little bit shocking for those who haven't already taken my classes, right? A bank gets to create money. They're not just lending out other people's money. They're actually a source of money printing, money creation. Wait a second, isn't that the thing that my economics textbooks told me is bad, that we should avoid, that we should not do too much of? Yes, the Bank of England made this very clear in a paper in 2014. Colleagues of mine, including Sally Omarova, wrote a piece called The Finance Franchise, saying that essentially, as I just said, we should think of it as almost like a delegated franchisee, almost like the way that, you have McDonald's, the company, and then you have individual people that can own a McDonald's store and make Big Macs under the same label. Well, individual banks get to make deposits that have all the guarantees of the government, but they pay a price, they pay certain costs, and in doing so, it's like they're walking around with a sheriff's deputy badge. They're their own actor, but they are exercising a delegated sovereign power. So what's different from the system that I was proposing versus the current system? Because I wasn't proposing we suddenly make banks delegated public issuers. I was saying they're already doing it. But unlike the current system, we're making it explicit. That was my proposal. Under a digital dollar system, don't be afraid if everybody leaves the banking system. We should just make the banks issue digital dollars. They can be the ones responsible for sending that new currency out into circulation. We already do this with insured deposits, but we call them deposits as though they're individual liabilities of the bank, and we create a limit. Maybe you've seen this limit if you go into a store, right? The Federal Deposit Insurance Corporation says that your bank account is insured up to $250,000. That number was a lot smaller when the FDIC was first created in the 30s. It's still capped at only about 100,000 euros in Europe. Some countries don't even have deposit insurance at all. So some of this money that we treat as equivalent to dollars, to currency, to legal tender, some of it is more guaranteed than others. Now, if you're the kind of person that has more than $250,000 of spare money, more power to you, I suppose. It's a luxury that most of us will never probably experience in our lifetime. So for most of us, this cap doesn't matter. So the difference between insured deposits and uninsured deposits is, for most of us, a theoretical problem. And then for the people that it isn't a theoretical problem, 9 times out of 10, when there's an actual crisis, we treat them the same. We bail them out, we back them up equally. If you're in one of the big 5 banks, your uninsured deposits have been guaranteed every time there's a crisis. Some small little banks in the last 20 years, we've let their uninsured depositors, people who are, rich people who are running businesses and things, lose some of those funds. But often, even then, we don't let them lose 100%. We send some of that, we take over that bank. The FDIC puts it into what's called receivership, which is a sort of step before bankruptcy, and sells its parts to other banks. So you might wake up one day with your account at the failing bank. The next day you wake up, it's at a new bank, and your money is mostly safe, maybe with a little bit of a write down, maybe a little bit of what they call a haircut. But most of the time, the difference between insured deposits and uninsured is more about the difference between de jure, explicit legal guarantees, and de facto, implicit political guarantees, which is still important, still very important, especially for actors that have to care about their legal responsibilities. You can't say to your customers, you can't say in a board meeting, well, it's not technically insured, but I'm pretty confident that they'll do it, and that be sufficient. So this distinction in practice may not look that different, but legally, in terms of risk management, can be very important. All right. The other thing that I was proposing, and this is more fundamental, was that if we move to a world where most of us kept our money at the central bank, then every time a bank needed to make a loan, they would actually probably need to get the funds the digital dollars that they would be issuing from the central bank. They didn't have any on hand. It's not like they had a vault, right? So what you would be doing would be providing that to the banks as a loan that they would then give out to the customer. It's sort of like someone coming and saying, hey, I want to be the person in town that sells Heinz ketchup on behalf of Heinz. Well, you still need to actually get the ketchup from Heinz Central Command. You pay a fee to them, right? You charge a better price to the people in town. You pocket the difference, but you are ultimately a middleman for the ketchup being produced at the main factory. So unlike the current system, where banks make their own deposits and then only get them backstopped by the government in times of crises, under a digital dollar system like I was proposing, you would start by getting the digital dollars from the government, and it would be very clear up front that the source of the money that the banks were lending out was the public rather than private banks and private investors. The other thing that that would imply is that the place to exercise discipline, and by discipline here, I mean making sure that they don't issue loans that shouldn't be made, that they don't slowly lower their standards, right? They don't slowly start becoming more and more exuberant, more and more what me worry about their risk assessment. The way to do that would be at the point that banks make loans. We know that the minute you make a loan, you approve a loan, you will be creating that money. So we need to make sure that we only let you create loans under the right circumstances, rather than letting you make loans without much supervision and then waiting till everything collapses and then working out whether or not we should make all of the depositors who got the funds whole, right? Whether or not we should let some of the individual people who got loans and who are holding that money lose it or not. So it's a version of looking at the problem ex ante versus ex post. Do you want to try to prevent the bad behavior before it happens, or argue about who should clean up the mess when it spills all over the floor? And my argument was, if we move from a system like we have today to one where we are lending out government money, we would be dealing with the problem preemptively more than ex post. So I wrote that paper back a long time ago to deal with the world of digital currency. That's still happening. That debate is still happening today in central banking circles, etc. And it forms part of the contextual backdrop to this crisis moment. But let's get into this crisis moment more specifically. First of all, 2008 was a big deal. For those who were there, for those who were paying attention, for those who remember, there was a lot of anger at the banking sector. There was a lot of recognition amongst policymakers that we need to do something. We need to prevent the kinds of excessive risk-taking and create an update to our regulatory regime. If you look back since the 30s at the major updates to banking regulation, shock horror, they usually seem to occur after a crisis. And in that moment, when the banking sector is coming to the government, coming to the central bank, begging for a bailout, begging for support, they sound pretty contrite. They sound pretty apologetic. They don't have the right to be very defensive. There's a lot of promises about how much better they're going to be in the future. And then, like so many of those kinds of promises, when things start to settle down again, everybody forgets. Everybody starts to say, well, that was a long time ago. Things are different now. I don't think we really need as much of those safeguards as we had back then, etc., etc. Those who may remember in other parts of classes I talk about, when it comes to privacy, there was periods of time when it would take essentially torturing somebody to get them to give up information about their friends and family to the secret police. And nowadays, of course, we just put it up onto Facebook just because we're bored. We've forgotten the risks, and we forget the risks of finance even faster. So the sort of more scrutiny, the more robust cop on the beat that we had approached the immediate post-crisis era in the early 2010s is in the rearview mirror and getting more and more hazy every day. We also have the end of an era of monetary policy, right? One of the things that we experienced after 2008 was an extremely sluggish recovery, extremely slow recovery. It was very hard to get to the level of economic growth that we had beforehand for a whole range of reasons, which would take up a whole event that I won't get into now. But as a result of that, the Federal Reserve kept interest rates very low, right? It's a policy decision. They kept it low, and they were buying up a lot of assets or lending against a lot of assets as collateral. That is to say, you bring the bond to the Fed and you pledge it the way that you would pledge your grandmother's ring at a pawn shop. And in doing so, the central bank had a big balance sheet. That is to say, it had a lot of assets there, that it had a lot of cash that it had created and lent out against. So this era ends. When did it end? Well, take a moment. What happened recently? COVID. We did a huge fiscal response, far bigger than we did in response to the global financial crisis. And very quickly, we found ourselves, thanks in part to supply chain issues and other things, facing inflation. And I've got my own thoughts. And again, we can talk about that for a whole hour if we wanted, about whether or not it actually makes sense, economically, theoretically, practically, to raise interest rates to deal with inflation. In part because when you raise interest rates, you also pay more interest to the people who are holding interest earning assets. So on one hand, you're trying to make credit more expensive by increasing the price of credit. On the other hand, you're also increasing the subsidies that bondholders get by holding interest earning assets. So it's a bit contradictory. There are other problems with it as well, but whatever we think about those problems, it remains that the current prevailing policy framework is when there's inflation, it's the Fed's job to raise interest rates. So it has in the last few years, it's raised interest rates from near zero, up to 5-6%. And at the same time, separately but coordinated, it has been trying to reduce its various lending facilities. It's been trying to reduce the amount of bonds that it was buying and lending cash against. It is trying to shrink its balance sheet. Now, unlike the interest rates, which I may disagree with, but at least there's an economic theory there. The idea of shrinking the balance sheet is almost purely a political phenomenon. It's designed to basically get the Federal Reserve out of the public spotlight. When its balance sheet is big, everybody's talking about it. All the attention, all the action is taking place there. Well, you don't really want that if you're the Fed. You like to kind of operate without much scrutiny. You don't like being in the news. If your name is in the news every day, it's not enjoyable. You prefer to be operating only in circles where everybody's there because they are financial experts. So the Fed has been trying to raise rates and shrink its balance sheet. And what that means is existing long-term bonds, particularly treasury bonds, which are supposed to be guaranteed by the full faith and credit of the United States, that is to say, no default risk, right? You and I issue a debt, maybe we can't pay it back. Well, the government has an infinity sign next to how much money it can create. So it doesn't have any problem paying back bonds when they come to maturity, right? You hold a 10-year bond, 10 years later, you go and get cash for it. But when interest rates go up, those old bonds are less valuable. And I hope I can make this point clear. And if it's not, feel free to ask when we get to the Q&A. But if you bought a bond, 30-year bond 10 years ago that paid 2% interest, 10 years later, it's equivalent to a 20-year bond that pays 2% interest. But if in the meantime, interest rates have gone up, why would anybody else want to buy your 20-year bond that pays 2% interest if they could go outside and buy a brand new, fresh 20-year bond that's paying 5% interest? Suddenly, you're holding a second-hand car in an era where brand new cars are cheaper. Why would anybody want your beat-up old car? So the act of raising interest rates makes the older bonds that were already issued less valuable, and it's happening at the same time that the central bank is saying we're going to buy up less bonds, right? So you have to sell at a lower rate, which means if you were holding those bonds before because they were valuable, you may actually be experiencing a loss. If you could hold the bond all the way to 30 years, you would get the full value. But if you have to sell today, you will get a loss. The other broader context is that the crypto markets, which were enjoying this period where they thought that they could only go up, right? Everything was looking good forever in 2020, 2021. In recent years, due in part to rising interest rates, due in part to a regulatory crackdown from the Securities Exchange Commission, and very recently, weeks before the Silicon Valley Bank collapse, Silvergate Bank, which is also a California bank that was specifically serving crypto actors, also went under. So there is a broader sense that we are entering a kind of bear market, right? That is to say, a market where economic conditions are not good, profits are not high, right? It's sort of like going to a casino on a night where everybody seems to be losing a lot. It's not a good time. So that's the broader context, right? What specifically happened at Silicon Valley Bank? Silvergate Bank that I just mentioned had about $70 billion. It's a small bank, relatively speaking. Silicon Valley Bank has 200 billion. It's a step up. It's about the 20th largest bank, or at least it was. Relative to the biggest banks, 200 billion is still pretty small, right? The biggest banks, the top five, are sort of in the realm of trillions of dollars. And, you know, if you're the kind of person that's used to thinking that getting a couple of $1 million from the legislature or from a client is a lot of money, I mean, these are the numbers that we think about and we talk about at this level. It's that sort of joke from the movie The Social Network. You know, $1 million isn't cool. You know what's cool? $1 billion. Well, none of those are cool. You know what's cool is $1 trillion, right? That's the scale that you have to think of when you're thinking about banking regulation and monetary policy and macroeconomic policy. The other stuff is small fry. So Silicon Valley Bank was relatively unique. Its balance sheet, its business model, it was very focused on one industry. There are other kinds of financial institutions that focus on one industry, most notably credit unions, but they're usually focused on a certain set of workers or maybe a region, something like that. Silicon Valley Bank was the bank that most tech entrepreneurs in Silicon Valley used. Not only the companies themselves, but the individual entrepreneurs and CEOs, thanks in part to some deliberate marketing strategies by the bank. They would say, hey, if you set up your company here, we'll give you concierge private wealth management services. We'll give you a personal mortgage. We'll give you a really good benefits on your checking account with us, blah, blah, blah. The result is that they had a very concentrated sectoral focus on one Silicon Valley centered industry. And unlike a lot of banks that diversify their customers, the majority of customers that this bank had were relatively wealthy individuals and or businesses. In particular, a couple of those businesses, which I'll get back to in a second, were entities that managed payroll for other companies. So they were holding funds there, not to try to earn a lot of money, but just so they could hold the money that they got in 1 week so they could pay their employees a few days later. So the average time that they held their funds in that bank might only be a few days, but it was very important that those funds were there when they needed it, because if you want to piss off your employees, one of the easiest way to do that is to not pay them their paycheck when they think it's coming due. Right, to tell them that actually they have to wait another 3 days for their monthly paycheck. Very easy way to get a riot in your business. So you had a number of large value customers where the average amount of money in their account was larger than $250,000. Remember, we were just talking about the $250,000 cap? Well, most banks, most of their depositors are mom and pop. This is a bank where they had very few of those. In fact, something like 94% of all of their depositors' balances were held in uninsured deposits, that is to say, above the $250,000 cap. The other thing that was unique about Silicon Valley is, unlike a lot of the banks in 2008, when they were engaging in all sorts of exotic products, all sorts of risky loans, all sorts of secondary market derivatives and securitized assets and securities based on other securities and an alphabet soup, the kind of thing that you have to spend 5 years doing complex finance to understand. The Silicon Valley Bank's model was actually relatively simple. They had a lot of people who were storing their money with them, not for the purpose of getting loans, but just to have an account. They were not doing a lot of aggressive loan making, but they wanted to have safety for their customers while also earning some nice interest. So what do you do when you want to not do a lot of lending? You don't actually have a lot of borrowers coming in your door, but you want safety and yield. The answer is that you invest in treasury bonds, government bonds, or usually short-term 3-month bills, all the way up to 30-year bonds. And you sort of have a variation of them. You have some in short-term so that you can turn them into cash when you need to. The rest you put in long-term. It's sort of like having a checking account and a savings account. You have enough in your checking account to manage your daily basis, and the rest you put into something that earns you hopefully a bit more interest, but is a bit locked up. You can still probably get it into cash when you need to, but you might have to pay a penalty or something, or you'll lose some of that interest that you're earning. So this is the business model. A lot of what we could think of as narrow banking activity, not loan making, not highly leveraged, just cash parked in some relatively boring bond that's hopefully earning enough interest to be profitable. The other thing that you got to think about, and there's a lot of complicated banking regulation, which we won't go into, is the idea that the banks had a requirement to keep a certain amount of assets in cash, something that could be highly liquid. This was a development post-2008, what they call the liquidity coverage ratio, and the legal technical regulatory term of art was high quality liquid assets, HQLA. Sounds fancy, sounds like something out of an ancient Roman movie. And the idea was if you did have depositors leave your bank, you could turn those assets into cash on demand, right? You could immediately turn them into liquid cash and make sure that you could make payments or withdrawals on behalf of your customers who needed it. Those IOUs, those bank deposits, could be turned into nice little green pieces of paper, or they could be transferred to another bank that would want to get central bank reserves in exchange, and you could sell them. The problem is 30-year bonds are not necessarily liquid, right? The whole point is that they are designed to be held for longer than a 3-month bond or an overnight reserve. How could this bank treat them as liquid? Well, first of all, the regulators let them. They let them call 30-year bonds high-quality liquid assets. They counted that as one of the categories that you could put under your high-quality liquid asset requirement. But even more important than that, perhaps, was that they used a special accounting treatment. That is to say, most commercial assets are valued on an accounting balance sheet under what's called mark-to-market accounting. So you wake up at a day or at the end of the week or whatever particular time period it is, and you look outside at the market value of that asset, and that's the price you have to put on the balance sheet. Right? You buy a $20,000 car. 2 weeks later, the market says that car is only worth $10,000. You have to record it now as $10,000. You have to mark down the value of your asset from $20,000 to $10,000. That's mark to market. The other version is hold to maturity, which is to say you could write it as if it was worth the full amount, as long as you never had to sell it. That's what hold to maturity means. If I held that 30-year bond, it was $1 million bond. If I held it for 30 years, it would be worth $1 million. But if I tried to sell it today, it's worth $800,000. So mark to market would say you have to call that $800,000 of wealth. Hold to maturity would say you get to call it $1 million of wealth. And the regulatory rules were such that the bank was allowed to call their 30-year bonds they were holding and other related assets like mortgage-backed securities as if they were hold to maturity. The problem is that you couldn't necessarily guarantee you could hold them to maturity. Why? Because they were supposed to be there to be sold in an emergency. The whole point was that you might actually need to convert them into cash at a moment's notice. So why are you allowed to record it as if you never need to sell it at a much higher value with the full knowledge that if you had to sell it, you'd lose money? Well, the bank should have known. I'm not trying to excuse the bank managers, the directors, right? They should have known. They definitely screwed up on this. The regulators should have known. They should have been keeping an eye on it. This is a $200 billion bank. What were they doing? They were asleep at the wheel. And the effect was there was a loss on the bank's balance sheet of at least $2 billion that was going to be realized the minute they had to actually deal with large level withdrawals. So the question becomes, who is going to face that? Maybe nobody. If nobody withdraws any funds, maybe everything's fine. You can just slowly, gently switch some of these out over time, right? But if everybody leaves at once, or if there's some other economic crisis out there that causes everybody to want to take their money out, somebody is going to be left holding the bag. Somebody is going to be left being the last person in line, and they're going to say, sorry, we've run out. We can't get any more funding. That is the prime condition for a bank run. What is a bank run? People think that there's a problem with the bank. They think that things are going to go badly and they don't want to be the last person in line. And in the process of trying to get their money out, they actually turbocharge the problem itself. Maybe there wasn't a problem at the outset at all. Maybe there was a problem, but it certainly got worse when you had to leave, when everybody leaves at the same time. In the past, the way that we resolved this problem, this used to happen all the time. We resolved this in part with FDIC insurance, but we didn't do it fully for reasons related to the politics of the moment in the 1930s and since. So Most of the time, we help most of the people, and we think that's most of the time good enough, mostly. Well, this was an example where that wasn't enough, right? Maybe you remember this classic scene from Mary Poppins where they try to take out tuppence from the bank won't give it to them, and everybody goes, they're not letting him take out their tuppence, quick, I want my money out, there must be a problem. And then suddenly there's a run on the bank. Well, all of these Silicon Valley investors are talking to each other. Maybe you have a bank account at Advantis or Umpqua, maybe you have it at Chase or JP Morgan, or hopefully not Wells Fargo. But it's very unlikely that you're talking to every other depositor at Wells Fargo or Chase, right? It's very unlikely that you're all on an email thread together. Anyone that's unfortunately been tagged in the email thread of a whole university knows how terrible those things are. Imagine being in a chat room with 250,000 other people, and the only thing you share in common is that you all bank at Chase. Hi, I'd like to unsubscribe from this chat, please. Well, Silicon Valley Bank was in the unfortunate position that most of the people who banked with it are birds of a feather. They're all in the Silicon Valley scene. They're all talking to each other already. They're going to the same entrepreneur conferences. Half of them are funded by the same venture capitalists. So it was quite easy for them to coordinate once they realized there was a problem with the bank. It was quite easy for them to say, we're going to make sure we get all our stuff out at the same time. So there was a coordinated withdrawal. I saw one newspaper article saying it was the first ever bank run coordinated on Slack or on Twitter, which was amusing to me, right? This is an example where the modern technological framework or context actually is quite important to understanding what happened. The bank immediately tapped existing emergency facilities. This wasn't made known to people until days later. What's called the discount window, which is the Fed's sort of final lending facility of last resort. It actually could and should be, in my opinion, used more frequently as a first resort, but quite ironically, there is a large degree of stigma. It's sort of like having to call your parents for a loan, and you have to tell everybody in your life you did it and wear a little sign around your neck saying, I had to get help from my parents. It's not a good look. Banks hate to do it. They would often rather go through a convoluted process of being taken over by another bank than actually tapping this facility. In an industry that likes to talk about the cold, hard, economically rational logic of capitalism, it's built a lot on feelings and implicit norms and all of that kind of stuff. In response, the government actually had a sort of extraordinarily quick reaction. Initially, it seems from the reporting that's coming out that President Biden was quite comfortable letting the bank go under, until he realized that there were actual hostages, real people involved, not just rich investors, but individual workers who would not get their payroll made, right? That their salaries, that their paychecks would not come out, and probably not the janitorial staff, more like engineers, but still close enough to average people for, old Joe to decide that it required a bailout. And they also started hearing from other banks that there were concerns that other banks had also invested in government bonds in a similar way under the same accounting rules, that they might be in trouble, and that a $200 billion bank failure could cause enough restrictions in the credit markets and more broadly losses in the cutting edge of the tech sector that it could put a dampener on other profits and make other businesses and things that are already feeling the pain of higher interest rates tip over themselves. So once again, like in 2008, like in the savings and loans crisis of the 90s, all the way back to the 1930s, we had a system where it was too big to fail. Somewhat unlike a lot of these other too big to fail moments. Again, it's important to note this was a kind of surgical strike. It was one bank or only a few banks around it that were considered too big to fail. It wasn't the entire economy that was at risk. It was just sort of Silicon Valley and a few larger uninsured depositors that were considered too important to let fail. So unlike some of these other crises where the hostage base is very large, it's everybody. This was almost so small that it showed just how far we were willing to go, not to let the financial system fail in a crisis moment. So what did the government do? A couple of different things. On the deposit side, which is normally begins and ends with the FDIC, the Federal Deposit Insurance Corporation, they invoked a systemic risk exception to a rule that was established in the 90s after the savings and loan crisis of the 80s, called the least cost rule. The least cost rule said you can only resolve bank failures in a way that puts the least cost on the FDIC itself, which usually means selling the bank to somebody else first rather than tapping the insurance fund, right? The insurance fund of the FDIC, in theory, is paid for by the banks themselves. They have a tax, which we don't call a tax because we don't like to call things taxes, right? When Obamacare was set up, we called it a personal mandate. And then Justice Roberts said, no, it's a tax. And when it's with banks, we don't call it a tax, we call it an assessment. Maybe some of you who've got classes right now looking at your assessments, maybe it feels like a tax to you. Well, in this context, it literally is a tax, but we call it an assessment. And the idea is that the banks themselves should pay the cost, not the public. At the same time, if that insurance fund is depleted, if it runs out, it gets replenished by the Treasury that issues government bonds, just like it would for any other part of the government budget. So it's a fiction that this is all private insurance. It's private insurance on the surface, and it's public money underneath all the way down. In doing so, the FDIC invoked this one exception, but the question is this really a systemic risk? It felt like it was just a couple of banks. Where's the systemic risk? Well, partially maybe it's to do with the bonds that I just mentioned, to do with that regulatory problem about the hold to maturity valuation of bonds. Partially it could just be this is a big bank, and if others get afraid. But if this bank is allowed to fail, what it would tell everybody is the only banks that are too big to fail are the top 5. So if your money is in a small to medium-sized bank and you see this fail, the next day you should be running to the big banks because it's the only place to guarantee safety. And we're actually seeing that right now with the smaller banks, the ones on the other side of Silicon Valley, little, small, regional, tiny banks. In fact, there was a Republican from Oklahoma who just quizzed Janet Yellen on this in a congressional hearing yesterday. And Yellen really didn't have a good answer to it, saying, why would anybody be silly enough to keep their money that's uninsured in a small bank now if they know that those banks will be allowed to fail, but the big ones won't? Aren't you essentially penalizing small local banks by saying they're going to have second-class citizenship status in the banking system? And she didn't have a good answer. The other thing the FDIC said was basically, we're going to guarantee them all. So that $250,000 cap that's been there since at least the 90s was basically dead letter now. People are saying, well, wait a second. If there's no caps on insurance, then anything a bank issues alone is publicly guaranteed in the crisis moment. Hopefully this sounds a little bit similar to where I started with my paper. And then lastly, who is actually going to bear the cost? If these banks are allowed to earn privatized profits on all of this activity, with the knowledge that on the back end, they will be bailed out, or maybe more importantly, bailed in to the insured system, the public is on the hook in that moment. If that's the case, why does the bank and its CEOs and its shareholders get to earn all the profits on the way up? Right? Where is the accountability? Where is the public-private balance here? The other side of it, and this is sort of more convoluted and complex, is on the asset side. Those bonds that were at risk of losing a lot of money if you had to sell them, the Fed stepped in and said, we will create a new program, a new facility called the Bank Term Funding Program, where you can come to us and we will buy up those assets without any discount. We'll buy them up at the full face value. Whatever the value that you had written down, we'll buy them at that value. This is a huge difference. In the past, the Fed, as I said, has had the discount window, and you would have to get a haircut. If you wanted to pledge collateral, right, your grandmother's ring might have been worth thousands and thousands of dollars, but that pawn shop is only going to give you $200 for it. And if you don't like that, find someone else. But they got rid of the haircuts. No haircuts anymore. You get full face value. We're going to give cash on demand against any asset you bring to us that meets the criteria of this facility. Again, hopefully this sounds a little bit similar to where I began my self-aggrandizing paper. This is exactly what I said should happen, and it took a crisis for us to do it. But the fact that we have now done it means we have to grapple with the implications going forward. So first of all, not only large banks, but the banking system entirely, and even the uninsured deposit system in its entirety, is now too big to fail unless otherwise indicated. Second of all, there is no market discipline on the deposit side. Uninsured depositors don't have to keep an eye on what the bank's doing, because if something goes wrong, the government's going to make sure that they backstop it. So if we want to have any discipline at all, we have to do it on the asset side, on the lending. We have to make sure we look at what the bank is doing before it does it. If we don't want them to create junk assets, we shouldn't let them create junk assets, rather than wait until they do and then try to say, well, we're going to let you lose money on your deposits. And then the fundamental last kind of vision of all this, the big question is, what does it mean to call this private banking when it's so inflected from top to bottom with public guarantees, public supports, and that kind of thing? And again, I would just put a little plug to the public banking conference we're hosting next week. So that's where I'm at. I've got about 10 minutes left. I'm happy to take any questions that people would have. Thank you for joining. Feel free to either put your hand up if you have any, or you're welcome to ask them in the chat if that's preferable. Yes, Paul, Professor Diller.
Hi. Yeah. So this is really interesting. I may have missed it, but like, what is your takeaway? Do you think the Feds should have stepped in here and done the bailout, so to speak, or not?
I think it's a bad way to make policy on the fly, but I think it is the right place to go towards. I think the deposit insurance cap was always a fiction, and it is good to dispel it once and for all. I don't think letting these actors walk away with the profit and the benefits that they generated along the way while taking risks they shouldn't is the right way to avoid moral hazard. But if the price to pay is this is the last time we ever do it this way, then that would probably be worth it to me. And I would still say that we should get accountability for those actors through clawbacks, through restrictions, through preventing them from ever working in banking ever again, etc. And we should have an independent review, because I don't trust the Fed to be honest about its own failings in all of this. And that's one of the big conversations that experts are having now, is that whether we should have an independent review of how this all was allowed to happen. But I think getting to a world where we stop pretending that we will let depositors fail, and taking the logic that we have opened the door here and opening it all the way, extending this protection to small banks as well, so they're not second-class citizens, extending FDIC insurance to be unlimited, as people all over the spectrum, progressives all the way through to Mitt Romney and even JD Vance, a proto-fascist in my opinion. Everybody on all sides of the spectrum is saying we should eliminate the deposit insurance cap. And so if this is a crisis that actually forces a fundamental change to the kind of trunk and root of the banking system and the monetary system, I will consider that a positive development. I think the last 5 years have shown, at least me, that unfortunately a lot of public policy making really only does proceed one crisis at a time. And as far as crises go, this is relatively localized.
So you want the government to insure every deposit up to infinity?
Deposits are a public good. The payment system is a public good. We should stop pretending that there is any private market discipline on the creation of deposits. But my view on that is we should go to the next step, which is we should issue a digital currency and have it just be digital currency. Let's get rid of deposits entirely. Nationalize the deposit side of banking. Not every bank, they can still make credit. They can still take individual risk. If they make a bad loan, they can go under. But the thing that they are advancing, right, is public dollars, right? We should have one thing called a Big Mac, and every franchise McDonald's in the country issues the same kind of Big Mac. Not there's insured Big Macs and uninsured Big Macs, and you have to make sure that you didn't get the one that's badly made with the wrong ingredients. They're all the same. We should have a generic product that everybody can store their funds in, because when you don't have that, we create this two-tier system where the most rich investors, where the most hedge funds, etc., store their money when they can't put it in a deposit balance because it is not safe. They put it in treasury securities. So we create this convoluted system of collateral and securities markets to provide the safety that we are not providing with the bank accounts. The other thing we do is we just allow people to make 25 different $250,000 accounts. We have a thing called an insured cash sweep, where you go to one bank and they call up 50 different banks and they put little pieces of money everywhere. It's sort of like, you've got a drug dealer that doesn't want to put all their money in one house because they don't want to get robbed. So they've got little pieces of cash with everybody they know. It's not a useful system. It's inefficient. It's convoluted. It takes up a lot of mental energy. Have one account, have it government guaranteed, have the money in that be explicitly public money, and then regulate the banks accordingly. They are delegated public actors. They should not be earning more than any other public servant on that basis. Yes, Justin.
Hello, I just had a quick question about the Fed and how these recent events. I know there's a lot of talk about a Fed pivot and how that's going to impact inflation and what they've been trying to solve in the last year and a half, 2 years.
Yeah, thank you. That's a great question. So as I said, part of this is that this is taking place against the backdrop of the Fed trying to raise rates in response to inflation post-COVID after a very long period of having low interest rates. My view is interest rates should be at zero permanently. And if we have problems with the financial system and the availability of credit, either too lax or too restrictive, we should deal with that directly. Rather than try to adjust this one weird trick interest rate. To me, it's the kind of logic of thinking that you can solve climate change with a carbon tax. It's so simple that it's attractive to people that don't want to get in the messy weeds of things. But you're in this weird bind, and I would recommend people look at my colleague Nathan Tankas's recent posts on notes on the crises on this. We are in a weird situation because, as I said, the risk that interest rates might rise, and in doing so that the long-term bonds you're holding are less valuable, that Silicon Valley kind of walked right into, is one of the most obvious risks of all time. I actually just watched A Fish Called Wanda again recently. There's this great scene where Kevin Kline gets killed by being rolled over by a steamroller, and he's just standing in place, and he accidentally forgets to move and his legs get stuck in cement, and it's sort of hilarious to watch him just slowly get rolled over by a steamroller. Well, Silicon Valley Bank had months to predict that interest rates were going to rise and to do something about their bonds, and they didn't. It's a very stupid mistake to sort of sleepwalk into. There were a number of banks that didn't make that mistake. And one of the ways that they did that was buying what's called an interest rate swap, right? Buying a hedge against interest rates. You still buy the bond, but you buy another product that says if the rates go up, I don't bear the loss on the bond, and you kind of hedge it out. Now, they're not hedging it out completely. Otherwise, they wouldn't be buying long-term bonds at all, but they're hedging out enough of it to reduce that risk. What that means is the Fed is in a position now where if it keeps raising rates, it is further exacerbating an already very fragile situation. And the European Central Bank actually just voted yesterday to raise rates, and it's questionable whether that was a smart decision. They did a similar thing in 2008, and it was considered in hindsight to be a very terrible decision. But they're also in the other side of it, which is if they say, well, we're in a crisis moment, we're going to lower rates again, make it easier to get credit, we're going to expand our balance sheet, then they're just walking back what they've been trying to do for the last few years. They're just, 3 steps forward and 4 steps backwards again. And so they are in a kind of awkward position now where they're kind of damned if they do and damned if they don't. And my view is, you made this bet. You shouldn't have tried to raise rates in the first place. This was a bad way to try to get out of the situation you're in the first place, rather than look at alternatives. But I think there is a kind of unavoidable pain that's going to come on one side or other on this decision. They can't do nothing, but both sides are going to take them in directions that are going to hurt certain actors. Palm just asked in the chat, last question, how useful do you think bank credit rating systems are, right? Especially for the average consumer. Silicon Valley Bank was downgraded once of their long-term investments, and all of a sudden they roll over and go bankrupt. I mean, I think part of this goes to this question, right? The regulators and the supervisors were asleep at the wheel. They should have seen this coming. Interest rate risk is almost the bread and butter of banking, right? If you miss this one, you are not doing the basics of your job. It's sort of like your job was to deal with food safety, and you've been watching rats just run directly off a bridge into the vat of soup, and then you wonder why everybody has health problems, right? You were literally standing there making sure that the job was, the point was not to let the food get contaminated. But I think the bigger problem here is to that underlying question I was just mentioning a second ago about risk and the fiction that there is market discipline. At the point at which we let banks issue these loans, as a point at which we authorize them to do it, pretending that we will somehow renege on that on the back end, I think is a fiction. And even if we do it some of the time, we don't do it all the time, we don't do it structurally. And rather than continue to try to uphold that fiction, to somehow make it true, to somehow deal with, turn that contradiction or tension, turn the volume down, we should just stop trying to put ourselves in an impossible situation. Stop trying to put a square peg in a round hole and acknowledge the public nature of the banks entirely. All right. Well, thank you. Those are great questions. I'm glad we got a few in, and thank you for those who stayed to the end. Hopefully we'll do some of these again in the future. See you on the other side. Bye.